Is it a work in progress or is it done? In other words, inflation will not get lower.
Of course, one can't be absolutely sure. I guess what I'm saying is if I were the Federal Reserve, I would not think about cutting rates until we knew that inflation was at or beneath our target. My sense is that we'll start to see inflation numbers pick up again end of the second quarter, third quarter. We'll start to see them pick up again, partly from the base effect, because it's partly the base effect that made the numbers so low in October, November, December, because we were comparing with a year ago when they were higher.
Adrian Day joins us today. He is the president of Adrian Day Asset Management, the portfolio manager of the Euro-Pacific Gold Fund. We are at the Vancouver Resource Investment Conference. Welcome back to the show, Adrian. Always good to see you in person.
Well, thank you, David, very much. I always enjoy interviews with you, although you're normally too well prepared for me.
That's not true. No one is ever too well prepared for Adrian Day. My audience loves you, so welcome back. Let's start by talking about what you told me offline, monetary policy, the effects in the markets, and what the Fed is doing right now. You recapped it much better than I can. So what do you think is going to happen to the markets this year, given that it's expected the Fed will cut rates?
Exactly. I've said you remember on the show last time, I've said for 2 years now, but gold will really take off when the market believes that the Fed will start cutting rates before they have quashed inflation. And we are right at that point right now. It's quite clear that the next move from the Fed will be to lower rates. Personally, I'm not quite as optimistic as some people are about the timing, when they will do it and how rapidly they'll do it. But there's no question that the next move will be a cut in rates. And once the Fed starts cutting rates, there'll be a whole series of them. And yet at the same time, they have not quashed inflation. Now we look at the CPI or the PCE numbers and you see, they've come down dramatically. But in the last few months, they've sort of stabilized and started in the US moving up a little bit, depending on what you're looking at. In Canada, they're kind of flat for a few months. My point is they have not yet killed inflation. And if you look at the Fed's own preferred measure of inflation, which is core PCE, we're still 60% above their own target, which is an arbitrary target to begin with, but we're 60% above their target.
So let me ask you this, is it a work in progress or is it done? In other words, inflation will not get lower.
Of course, one can't be absolutely sure. I guess what I'm saying is if I were the Federal Reserve, I would not think about cutting rates until we knew that inflation was at or beneath our target. My sense is that we'll start to see inflation numbers pick up again end of the second quarter, third quarter. We'll start to see them pick up again, partly from the base effect, because it's partly the base effect that made the numbers so low in October, November, December, because we were comparing with a year ago when they were higher. That base effect is going to flip a little bit as we get into May, June, July, August. So that's one thing. And the other thing, of course, is oil. Oil is particularly low right now, or is low right now, I should say. So the potential for oil to move up over the next 6 months, I think, is real. And of course, if the price of oil moves up, that affects the price of every good in the store. So I'm not an oil analyst, and I'm not putting money on a higher oil price. I'm just saying I think the risk in inflation is on the upside, not on the downside.
So in regards to inflation, we know that recessions in the past have been deflationary, if not disinflationary events. So let's talk about whether or not we will get a recession, because assuming that the past repeats itself, then a recession could mean lower inflation. What indicators are you looking for to tell you whether or not we're going to get a slowdown, a contraction, or a recession, whatever you want to call it?
Yeah, I think a recession is inevitable, all but inevitable. Nothing's inevitable except death and taxes. But I think it's all but inevitable. And all of the indicators you look at, whether it's a leading economic indicator, whether it's manufacturing, all of the indicators are pointing down. The increase in debt, I think, is a very significant one. You look at the debt levels on credit card balances, you look at credit card defaults, because of course the balance goes up before they default. Both of those have shot up to 10 and 20-year highs, depending on which one we're looking at. And it's worse among credit cards like Capital One, Discover, It's worse there than it is, say, at Chase, but certainly worse than American Express. So Discover and Capital One, our credit cards are typically, their market is more lower income people.
Yeah.
And those are the people that are really hurting. So when you have over 5% of your credit card defaulting, that is an astonishing number when you think about it.
I have a few stats here that may indicate the economy is not as weak as some may think. I'll just let you comment on whether or not these stats mean anything in the grand scheme of things. First of all, consumer sentiment has continued to rise. Retail sales are actually up 0.6% month over month in December. Existing home sales fell. Well, we can talk about the real estate market later. Unemployment rate is still very low.
Right.
So all these indicators tell us that the consumer is still relatively optimistic and the labor market is still relatively strong. Correct or incorrect?
No. Well, I'll say one broad thing to begin with, which
Yeah.
is anytime you look at economic statistics, there's such a range, but, you can pick one over here and I'll pick one over there.
Sure.
There's always good, there's always bad.
Sure.
The Empire State Manufacturing Index that came out last week, was just astonishingly weak. If we look at what you're talking about, we'll come to unemployment in a minute because that's very important. But I think with retail sales, when you see retail sales holding up very well and moving up, but at the same time credit card balances moving up and credit card defaults moving up, does that signify that the consumer is very strong? Or does that signify that the consumer has not yet learned to tighten his belt? And I think the latter, not the former. I mean, if we were seeing consumer spending strong, but credit card balances remaining relatively low, then yes, I'd be much more optimistic.
Now, credit card delinquency rate, that's been rising. In fact, it's now at the highest level since 2012, higher than the pandemic level.
Right.
Now, obviously on the surface, this doesn't look good, but is there perhaps an explanation as to why people are defaulting on their credit card payments? Certainly isn't because interest rates are getting higher, because, they're not.
Well, credit cards have moved up over the last year and 18 months, of course, and a lot of credit cards are now charging 24, 25%. Some are charging 29%. So if you've got a credit card balance and it's gone up from 15% to 29%, that's meaningful. So, more, and as well as I do, when you have debt, more and more of your income is simply going to service the debt. You're not getting ahead at all. And so if you want your spending to remain level, then obviously you have to increase the debt.
Yes.
So when we look at consumer spending, I mean, you all the consumer spending numbers are in terms of dollars spent, and I don't want to gainsay it too much. Consumer spending is strong, but it's not as strong in my view as it appears. A, because of a credit card. B, because for spending volume to remain where it is, and volume might be the amount of stuff we buy. It might be the quality of stuff we buy. Do we buy a $5,000 Brioni suit, or do we buy a $2,000 hickey whatever? Do they still exist anymore? I don't know.
I'm not sure what you're referring to.
Oh, well, that's probably a brand that went out of business 30 years ago. Sorry.
Okay, I've never heard of that
brand. It was a Nordstrom.
Okay.
Yeah, Nordstrom sold
it.
Hickey Freeman.
Okay.
Hickey Freeman. Anyway. But if people are moving down and not spending, remember you're spending as much in dollar terms. But if prices are up by 10%, you should be spending 10% just to stay flat. That's what I'm trying to say.
Okay, let's assume that what you said earlier is going to happen. That recession is inevitable. Let's just assume it's inevitable for the sake of conversation. Does that mean that a gold price surge is also inevitable? True or false?
True or false? You sound like a congresswoman.
Or somewhere in between.
My answer is nuanced. You've got to look at the context.
Yeah.
Sorry.
That's okay.
I mean, again, inevitable is a dangerous word in investing.
I understand.
Especially when you look at the last 18 months, where virtually all of the buying in gold has come from central banks. Virtually all of it. I mean, ETFs have had steady outflows for the last 18 months, other than February, March. Even in the last month, they've had outflows. Coins, All the coin dealers I talk to, sales are down, premiums are down. So all of the gold buying in the last 18 months, primarily, virtually all of it has been from central banks. And so the danger there, when you're looking at literally a handful of players who've supported the gold market, they can decide not to buy for 2, 3, 4 months for whatever reason. Supposing China doesn't buy any more gold for 3 or 4 months, for whatever reason. Doesn't mean they've changed their mind, doesn't mean they're going to start selling anytime soon, but that would have a meaningful impact on the price of gold. So, other than something like that happening, no, I think it's almost certain that the price of gold will go up. First of all, for 3 reasons. First of all, I think 3, I don't know. We'll come to it. First of all, if you look back at every time the Fed has started cutting rates after a rate hiking cycle, the next time they start to cut rates, gold has moved up dramatically. And that's logical. The second thing, what was the second thing?
Who's counting, right?
Who's counting? Well, that's the first thing. The second thing is that if we are entering a recession, as I think we are, gold actually tends to do well in recessions. People think recession,
right.
Don't want to be in gold stocks. It's a logical kind of thing. Oh, Fed's cutting interest rates, I want to be in a broad stock market. But in fact, both of those things, historically speaking, are fallacious. The broad stock market starts to fall when the Fed starts to cut rates. And it's not because the stock market falls because they're cutting rates. It's because the stock market is because in an environment where the Fed is cutting rates, typically you're in a recession. If we're in a stagflationary period, which I believe we're entering, with inflation up and a recession, that means companies are going to get hit by higher costs and by lower sales, and so their profits are going to get squeezed. That's on the broad market. As for gold, again, it's not so much that a recession is good for gold, it's just that in a recession, the Fed starts to cut rates, cutting rates is good for gold. So if you look back at the last, all of the recessions, so 10 recessions back to end of the 1960s, in all but one of those recessions, gold went up. And the one where it went down was in 2000, the dot-com bust, where it dropped by half a percent. That was when the European banks were dumping their gold, if you remember.
Right.
So in pretty much every recession out there, gold has gone up. In a majority of recessions, gold stocks have gone up, which is sort of surprising. And in the 3 recessions where gold stocks went down, they went down by 2%, 4%, and 5%. The ones where they went up by 30%, 80%, 197%, etc. So a majority of recessions, gold stocks have gone up and gone up by a meaningful amount. And here's the critical key. Yeah. In every single one of those recessions, gold stocks outperform the S&P.
Right. We're at a resource conference. Let's talk about picking gold stocks in the gold mining sector. Let me make you a blanket statement. Please agree or disagree with that. Buying a gold stock is basically a call option on gold itself. If it goes up, you make it. If it goes down, you lose a premium and not much more.
No, well, I don't 100% agree with that. I mean, I definitely think it's true, but if you're in an environment where the gold price is going down, you have a very, very significant headwind, and it's very difficult for any stock to any gold stock to make money. And the opposite is true. If the gold price is going up a lot, rising tide raises all ships and all that stuff. So you've got a tailwind. And yes, I mean, broadly speaking, if the gold price is not going up, you really don't want to be in gold stocks, broadly speaking. But you only have to look at a stock like Franco-Nevada, which did very well from 2011 to 2018, when the gold price fell sharply and other gold stocks were down 80%, still did well, still gave you a return. I can't quote it off the top of my head because, sorry, I wasn't looking. But it still did well. So broadly speaking, I would say that your statement is true, and it's certainly true of the producers more than the exploration companies, because of course an explorer can have a great discovery, and that will build value whether the price of gold is going up or down.
Is it possible for a project to just do exceptionally well because of micro forces and defy macro forces? Let's say it has nothing to do with the gold price itself. Yeah.
No, it is. But again, it's a huge headwind.
Right.
And so the number of stocks, whether they're large cap stocks or small cap stocks, the number of stocks that do well, number of gold stocks that do well when gold is falling is very, very small. And part of that is not just because people can't make discoveries, but they can't raise money.
Yes.
So if an exploration company, I'm waving my hand at all these hundreds of companies in here, if an exploration company can't raise money, they can't do any exploration, which
Right.
means they can't make a discovery.
Right. Now, Adrian, tell us about your process in picking stocks. You don't have to give specific names if you
No,
don't want, but
no.
generally speaking, your strategy.
Well, the first thing I always look at is the people. People are critical to me. I'm not a geologist,
Right.
so I don't have an edge when it comes to looking at geology. So people are critical, and that's true of large cap companies, it's true of small cap companies. It's much, much truer of smaller companies and of larger companies, but nonetheless, you have to ask yourself, will Franco-Nevada be Franco-Nevada if it hadn't been for Pierre Lassonde and Seymour Schulich and Dave Hartwell, would it have been the same company? And you only have to look at Agnico Eagle and look at the great management they've had for 40 years. Would it be the same company if someone else had been running it? And then look at a company like Barrick, for example, when they merged with Randgold and Mark Bristow took over as CEO. One can argue about Mark Bristow. I mean, I think he's a great CEO, but nonetheless, everybody can see the transformation in the company that came because of the CEO. So people are critical. That's the first thing I look at, particularly when you go further down the scale. And I've always said that I'd rather a good person, good team with no money and no property or a lousy property than a great project with lousy management.
When you say good team, can you elaborate on the qualities of this team?
Well, one thing you obviously look at is their track record.
Right.
And that's difficult because everyone has to start somewhere. But what is a person's track record? And, the truth is that you go to a lot of companies and you see faces that you've seen for the last 50 years and they have never been successful in 10 different companies. Well, there's no point in even talking to those people, in my view. It doesn't mean good people won't have failures, of course. But if a person is consistently successful, like say Ross Beatty, who's been called a broken slot machine, I'm willing to give Ross Beatty a lot more leeway than I would someone else.
What does someone like a Ross Beatty do differently in the management style process? Yeah.
That's a good question. That's a really good question. I mean, first of all, he's incredibly smart. Now, not every smart person does the right thing. I think he's incredibly smart and incredibly focused. That's important. He's focused, and when he's involved in a company, he's focused and dedicated and works hard on that company. There's too many people who might be CEO of this company and a director of that company and an advisor to that company and and he does a podcast on the side. What are you really focused on? It's hard work.
Right.
Yeah, I would put it down. Okay. I would put it down to that, and also the way you treat other people. That's very, very important.
Yes.
And we've seen that many, many times. It's less of a problem now, I think, in the industry. But even now, it's still a problem when a North American company or South African or British company goes to, let's say, an undeveloped or third world country, and they just don't have the patience to take the time, to get to know people and to accommodate the local way of doing things. In North America, we tend to be we want things to happen. We think we can go down, what do you want? This is what I give, let's sign it, let's go. Mm-hmm. But as you know, in a lot of, in the hills of the Andes, it doesn't work that way. And you've got to spend time and you've got to be patient, and that's critical. That's absolutely critical.
Final question. How do you think the seniors are feeling this year about buyouts? Are you feeling in the air more M&A opportunities for 2024?
I'm not sure we're going to see a dramatic sea change over what we've seen. We've seen quite a few in the mid-tiers anyway, right?
Right.
And of course we saw Newmont and Newcrest recently. And Barrick, of course, is looking at First Quantum and, keep looking, but keep passing. So So I think we'll continue to see some buyouts, both big caps and small mid-tier, but I'm not sure it'll be a sea change.
Okay, excellent. Where can we learn more from you, Adrian?
Well, if you go to adrianday.com, you can go left for the newsletter and right. I think it's a bit like Tinder, right? Swipe right for the money management and swipe left for the newsletter.
Interesting. All right. Well, Adrian Day, thank you very much for coming on the show, Adrian.
Thank you.
And we'll put the link to your website down below. Thank you for watching. Stay tuned.